Good evening, members. Myself, CA Chawla, welcome you all in this today Webathon series, day 20. Today we will cover section 115C to 115 JB of Income Tax Act, and we will cover chapter 12A, special provision relating to certain income of non-residents, chapter 12B, special provision relating to certain companies, definitions, tax on investment income and long-term capital gains,
ठीक है ठीक है
return of income not to be filed in certain cases, deemed income relating to certain companies, special provision for payment of tax by certain companies, question and answer. And now I request CA Sunil Garji, moderator of this webathon, to please start this webinar of today.
Thank you, Raji. So now we are on 20th day of this webathon. Great effort by Dr. Raj Chawla to decode the whole Income Tax Act, and we are getting a lot of appreciation. Thank you, Raji, for your continuous efforts towards the profession. And I welcome Shri R.K. Ballaji, who is the session chairman today and very seasoned professional, and our today's speaker, Shri Prakash Sinha ji. He has also taken the previous session on the special rate of tax, 115A,
हेडफोन है
and other provisions were taken up. And friends, today topics are very interesting, very interesting, and they always haunt us in our day-to-day practice. And one of them is, of course, the minimum alternate tax MET. How to calculate it, why it was brought in. There were zero tax companies, and in 1997, MET provisions were brought in to tax the companies on their book profit. Certain adjustments are there. How to make those adjustments, our learned speakers, Shri Prakash Sinha ji will tell you. And then came alternative minimum tax, AMT. But the most important part of today's journey, today webinar, will to see the taxability of business trust. This concept of business trust, especially there are two kinds of business trust. One, of course, is the real estate investment trust, and another is infrastructure investment trust. And the government has given them a special status, a pass-through status. And the purpose is to have funds which can invest in the infrastructure. And you might be knowing a special exemption under Section 10 was given to the Provident Fund Investment Trust coming from Gulf countries in the budget provision itself. But the business trust has passed through status. For certain items, they have passed through. For certain items, they have to tax themselves. Which item will be passed through state, which will have pass through status. How to compute the capital gain. It's a very interesting to see. And third part of the webinar will be taxation of non-resident Indians, NRI. There is a chapter 12A in the Income Tax Act. बहुत कम लोग जानते हैं, मैं भी नहीं जानता था. मुझे भी आप प्रकाश जी ने बताया कि सर ये भी एक चैप्टर है. Until now we have understood about the taxation of resident or non-resident. But a very small chapter is there, 115C to 115I, where the non-resident Indian, especially those Indians who are coming to India and having the status as non-resident Indian and having the assets in foreign currency, and they want to continue with the foreign currency assets, then there are special provisions under section 115C to 115I. So these are three part of today webinar. Our learned speaker will have uh, a thorough discussion on these provisions. And those who have joined the webinar today, I will request them to post as many as queries they can post. And especially they should at least mark their attendance so that we can know who has joined us by name. And today's our session chair is very seasoned Dr. R.K. Bashir, R.K. Bhalla ji. Now I hand over the mic to Raj Chawla ji again to invite our session chairman for today's webinar. Over to Raj Chawla.
Thank you, CA Sunil Garji. Now I request CA RK Bhallaji, a very senior chartered accountant who has written various books on GST also. He is just 72-year-old. So, Bhallaji, your welcome speech, sir.
Thank, thank you, Raji. I'm grateful to you that you have provided me an opportunity today to be immersed with the very learned speakers, Sunil Garg and Mr. Sinha. And the topic is chosen is very interesting and useful for the professionals. And one thing every professional should know that that the taxes and death are certain. We cannot avoid, and none of the government can survive without taxes. Taxes are the source of the revenue of the government. As body cannot survive without blood, government cannot survive without taxes. But for tax matter, one thing is there and important to note that government is entitled to recover the legitimate due tax from the SSC. Whatever taxes are due to the government, that they are authorized to recover. And due to any technical lapses, procedure, and any other mistake, that tax cannot be charged by the government due to the reason that due to certain mistakes you have deposited. As you know, nowadays under the GST regime, what the department is doing, they said you deposit voluntary tax and file DRC 03. Whether tax is due to you or the government, whether tax is payable by you, that is a procedure. When there is a demand, then you can pay the tax. When there is no demand, then voluntarily depositing of a tax by cautious method is not good. So what I want to emphasize on the issue, the legitimate due tax should be given to the government. And any lapses on the part of the assessee, you say assessee sometimes forget to provide depreciation in the books of accounts. It is the duty of the AO to calculate and provide the depreciation before calculating the taxable income. If assessee prima facie omit to claim certain deduction which are otherwise available to him, it is a duty of the AO to consider that and provide that. It is not so that due to clerical mistake, if we have omitted certain things, and then we are not entitled to claim that things. And the topic of the international taxation is very important, and it has its impact on the Indian taxation as well as the global income taxation, and subject to the double taxation treaty with the other countries which India has entered into. That should be looked into also for taking of the international taxation. And now we have today with us learned CA Sinha ji, who will deliberate on the issue of the international taxation. Thank you very much.
Thank you, Bhallaji. Now I request our guest speaker, CA Prakash Sinha ji, to please start his deliberation.
Thank you, sir. Respected Chairman, sir, Bhalla, sir. Respected Raj Chawla, sir. Respected Sunil Garg, sir. And respected all the participants and all the persons who are involved into this webinar. As I have been told that this is a series of the webinar is going on, and maximum of the chapters has already been covered. After me, there are a lot of renowned speakers are also in the pipeline here, who will be deliberating on the important topics here. And I can understand that this is a very good seminar. In fact, a series of seminar where a participant can learn and participant can deliberate and participant can raise their issues on the various section by section discussion on the income taxes. There may be lot of seminar on the topic wise seminar are there, but this is the first seminar what I have faced till now, where we are trying to cover section by section complete code. In fact, it is from starting 1 to till the miscellaneous chapter here, and I am into the chapter 12. So it is a very good part, and in fact I'm in the bit in between here. I'm discussing on the chapter 12, and the chapter 12 has something very much important, which Garg Sahab has already mentioned, that it is a tax determination of tax in special cases here. Last Friday, I had an opportunity. Last Saturday, Friday, I had an opportunity to discuss few of the provision of the chapter 12. Chapter 12 starts from 115A, and its goes on a long section, and it covers different type of incomes also. Today, our topic is to, as Garg Sahab had mentioned, that is in 3 parts here. First part, we will be discussing about something about the MAT provision and corresponding AMT provisions, and particularly how to take the credit of the MAT and few of the amendment which has come on the MAT provision under section 115 JB. This is the one part of the discussion, MAT and AMT. After that, most important part that we will be discussing about the taxation of the trust. Taxation of the trust is a quite complicated subject. Why I'm trying to say it is a complicated subject? Because trust is not a person under section 2 sub clause 31 of the Act. When a trust is not a person, how to understand a trust? Because trust is a fiduciary person, it is a fiduciary body which can be considered under the BOI and or the AOP, and how we have to understand that part, that is a quite intricacies here. Further, a trust is represented by a trustee, means the residency of the trustee will also determine the residency of the trust also. Since for the purpose of section 6, the management of the trust is very much important, from which place the management of the trust is taking place. If the management of the trust is wholly outside India, then we can say that the trust is a non-resident here. So the trust taxation is quite important taxation, because it does not involve only the Income Tax Act, but before that we have to understand the Trust Act itself, how the trust is formed, what is the difference between the discretionary trust, non-discretionary trust, private trust, public trust, private trust, public trust, this type of trust. Unless we understand this part, then we can come to understand which are the trust we are dealing with. Like Sunil Garg Sahab has mentioned about the REIT and InvIT. Yes, REIT and InvIT are created as a trust, but these are the body which are governed by the SEBI, because the unit holders are the public outside India or the public in India. So therefore, REIT and InvITs are the body which are governed by the Trust Act, and we have to see that how this of income from the distributed income from the REIT or the InvIT will be the income of the unit holder in the same nature, means they are the pass-through entity. They are the pass-through entity, means that if the tax will be taxable in the hands of the unit holder, the REIT will be only a pass-through entity. And why this pass-through entity, we will also discuss this part. Third limb of our discussion and the last limb of our discussion will be the taxation of the non-resident Indians. We know that lot of non-resident Indians are investing in India. They have the lot of investment in India. for the purpose of non-resident Indians, it is very much important to understand the FEMA interplay with the Income Tax Act. So there is a FEMA part, there is a income tax part, and after that income tax, there is a double tax avoidance agreement also. Government has, in Finance Act 2020, government has brought the changed the definition of the person resident in India, and by way of Section 61A, even a person who has not ever visited to India, he can be a resident of India if he is not liable to pay tax anywhere else here. The term law not liable to tax was very much discussed in different forums. The, it was not defined into the statute here, income tax statute. People were taking the help of the different DTA for this purpose. There was a lot of hue and cry was there, particularly those work, our Indian brothers and sisters who are from Dubai or who are from other country where there is no such type of issues. That issue was raised before the finance minister, and after that they were forced to issue some clarification after the budget was given here. In this budget 2021, section 229A, I feel that the term liable to tax has been explained this time, and lot of issue, although they have defined the term liable to tax, but still lot of issue are pending, lot of juice are there, and we have to understand how a person can be taxed in India if he is not a taxable person. This means he is a stateless person. If he is a stateless person in any other country outside India, then he will be taxable in India. And for this reason, he is not required to even visit India for a single day. Only thing is that there is a certain threshold has been prescribed. So the interplay of these are the sections that is very much important. Further sections are about the NRI. So as I mentioned that NRI part will be three limbs here: income tax part, FEMA part, and the international tax part here. Yes, and there is a special cases where the special provision has been given to the non-resident Indian. It says that if the non-resident Indian has invested in the specified securities in a foreign exchange, then in that case, the non-resident income will not be subject to tax. There is a certain point line has been given because the government of India needs the foreign exchange. After that, if there is a transfer of this long specified security, and this specified security is also invested in some rollover processes there, then they have some tax relief that has been given to them. So these are the three limbs which I'm trying to confine my discussion. I hope that given the time frame, I will able to discuss a bit here. Yes, I understand the three limbs are a separate limbs. Three limbs are in fact a complete discussion itself here. I will try my best to complete this within the given time frame. For some of the part, I have prepared the PPT. In some of the part, I couldn't have prepared the PPT, but yes, will be able to discuss extempore here. That is not a problem here. So, with the permission of Raj Chawla sir, may I start the presentation of the PPT, sir?
Please continue, sir.
Thank you, sir. Whether my PPT is visible, sir?
Yes, sir. Yes, sir. Make it full screen if possible.
Yes, sir. I will conclude.
Yes, sir. Perfect. Please continue.
These are the presentation of my study or of my earlier PPT. I'm just running through that part. I'm not. Yes. 115 JB term 115 JB, that is the first discussion of our point is that why we are going to discuss that 115 JB. A company is supposed to pay the tax on his income. Any person, like if you go to the section 4, which is a charging provision, which says that tax has to be paid on the total income. The term total income has been defined under section 2 subclause 45A. The total income says the income, the total income as defined in section 5, computed as per the provision of this act. Means the total income means the total income covered under section 5 computed in accordance to the provision of this act. When we go to the section 5, we see that for the purpose of section 5, there are two limbs of section 5. Section 5.1 is the limb for the purpose of resident. For the section 5.2 is the limb which talks about the non-resident. 5.1 talks about if a person is a resident, what is the scope of the total income? It says that any income from whatever the source is immaterial, which is received or deemed to be received in India, or that will be part of the income which is accrued or deemed to be accrued in India, that is also included, and income which is accrued or deemed to accrue outside India, that is also included for the purpose of section 5. For the purpose of non-resident, there is a difference here. 5.2 says subject to the provision of this act. This means when it says that subject to the provision of this act, in fact, the section 5 also talks about subject to the provision of this act. This means there are certain provision which will supersede the section 5. How to calculate this part here? How to understand this part here? Because section 5 is very much important here, because this gives to understand the scope of the total income. And when the section 5 starts, both for the purpose of resident as well as the non-resident, we see that it starts with the line subject to the provision of this act. This means there are certain provision which will supersede the section 5. And what the section 5 is? The total income. It says the total income of any previous year of a person who is a resident. This means if a total income of any previous year of a person who is a resident includes all income from whatever the source. So source is immaterial. It says that whatever the source, it does not say wherever the source must be in India, but it says that whatever the source derived, which one is received or deemed to be received in India in such year on behalf of such person. If it is received or deemed to be received in India on behalf of such person, then it is a part of the total income. Accrue or arise or deemed to accrue arise in India to him during such year, that is also a part of the total income. Or accrue or arise to him outside India during such year. So it is even if accrue or deemed to accrue arise outside India, that will also be included in the total income of the resident. So therefore, we generally say the resident, for the resident, global income is taxable. Global income is a general word. It is not a word that is coming from the statute. It says that yes, if you go to the section 5, subsection 1, we find that there is a 3 limb of 5.1, 5.1a, 5.1b, 5.1c, and all the 3 limbs. If we include all the 3 limbs, then we find that all the income of the resident will be taxable in India. However, for the purpose of 5.2, which deals with the non-resident, it says that subject to the provision of this act. This means this provision also says that there are certain provision will supersede the section 5 here. So the section 5 is not a sacrosanct provisions. There are certain provisions which will supersede the section 5 here. We say that subject to the provision of this act, the total income. What will happen? The total income of any previous year of a person who is a non-resident includes all income from whatever the source. So whatever the source is immaterial, it derived with, is received or deemed to be received, received or deemed to be received in India in such year on behalf of such person. If it is received in India or deemed to be received in India by the non-resident, then such income will be taxable in India. Second part is that accrue or arise or deemed to accrue or arise. Accrue, we know that it is, if it is accrue in India, then it is taxable. Arise in India, then it is taxable. Deemed to accrue, where the term deemed to accrue, the term section 9 will come into play, because the section 9 defines the which are the income which is covered under the deemed to accrue, and after that deemed to arise is also there. So for the purpose of the non-resident, 5.2 is important, and we go to the 5.2, we find that there are two limbs, not the three limbs as per the resident here, only two limbs. What are the limbs? It says that income which is received in India, that will be taxable; income which accrue or arise in India, or income which deemed to accrue or arise in India, that will taxable in India. Now, we know that, okay, what are the deemed to accrue or arise in India? I'm not going into the litigation of the deemed to accrue in India. We know that the income has to be on the total income. The tax has to be on the total income, because the section 5 talks about that tax has to be on the total income. And total income means the income which is computed, income which is covered under section 5, computed as per the provision of this act. Then issue arises here. Then a person will liable to pay the tax on his total income, and he will pay the tax. But the matter does not stop here. Lot of company, due to his planning, has become, although they were profit as per the Companies Act, but they were not tax. They were zero profit under the Income Tax Act, by way of either depreciation, by way of any other benefited, by way of deduction here, or any other provision. They were not paying the tax in India here. The provision of the 115J(b) talks about the tax which you have to pay, and that tax is called the minimum alternate tax. Why this term is minimum alternate tax, and to whom it is applicable? It is applicable to all the companies. When I will say that it's company here, this will include the company, foreign company, in domestic company, in Indian company, domestic company, as well as the foreign company. But for the purpose of foreign company, only those company whose permanent establishment is situated in India. First of all, only those company whose permanent establishment and is situated in India, and based on the permanent establishment situation in India, that is covered under Article 7 of the TTA, and that is paying on the tax on the net basis. This means if the company is paying the tax on the net basis, then only their income will be taxable, or their income will be covered under the MAT. So Indian company will be covered under the MAT. Foreign company will also be covered under the MAT. Only those foreign company which are subject to the net basis taxation. Now issue arises here. Take a few line difference. Whether all foreign company which has the P in India, that will be subject to MAT? The answer is no. Those companies which are paying the tax under the presumptive taxation, like section 44B, 44BB, 44BBB, 44BBA, these are the few provisions. These are the four sections where the foreign company is subject to pay the tax at the rate given into, like 44B is something different for the purpose of aircraft, for the purpose of non-resident who are engaged in the business of the aircraft into the international traffic. 44BB is for the non-resident company who are engaged into the business of the mineral oils or mining, that part which is covered under the 44BB. They are subject to pay tax at the rate of 10% on the net income. That will not be covered here. So these are the 44BBB talks about the companies which are covered under the construction company. They will also be not covered here. These are the few sections where the MAT will not apply. Now come to the issue that what is MAT? So MAT is itself a complete code. Why I'm saying that it is a complete code? It itself says that what will the computation method for the purpose of determining the tax liability, I will compute according to this one. So it says that whatever the profit that has been computed as per the Act, as per 28 to 44, leave it apart. What is the net tax liability? The net tax liability should not be less than, now it is 15%. Earlier it was 18.5%. The net tax liability should not be less than 15% of the book profit. So if that is there, the book profit shall be deemed to be the total income of the tax, and the tax payable shall be 18.5%, or now it is 3%. If that is so, if the tax payable is less than 18.5% or the 15% of the book value shall be deemed to the total income. So what we are calculating here, we are calculating the deemed book value and book profit, and that book profit shall be deemed to the total income, and the tax payable shall be the 18.5% on that part here, which is very much important. So minimum tax should be that we have to calculate that what is the book profit, and on that book profit 18.5% or now 15% that has to be applied here. I hope that for this purpose, so the issue arises here. Most complicated cheese is that what is book profit, how to calculate the book profit, what are the elements that we have to add, what are the elements that we have to subtract in order to compute the book profit. Whether the book profit and the profit which will be computed as per the book profit as per which has been prepared as per the profit and loss account statement or as per the Company Act, both are same. The answer will be no. Both are not the same. The books and profit, for the purpose of the calculation of the book profit, the starting point is that the books of account which has been prepared following the Schedule 3 of the Companies Act 13. However, if there is a special company which is covered under Section 129 proviso clause of the Companies Act, for that there is a special method to calculate the book profit. However, they have given an alternative. They have the option that they can follow the Schedule 3 of the Companies Act, and based on the Schedule 3, they can prepare the financial account statement. What I am trying is, it is already into the statute, and we are all doing this part here. When a company is in loss, we are already paying the tax as per the minimum alternative tax. This tax, whatever that we will pay, it is not an actual tax liability. It is an alternate tax, means this amount, the excess amount from the actual payment of the liability will be subject to the credit, and this credit will be available to the SSC for the next 15 years here. We will see how the credit is available here. First of all, we will go that what are the permutation and combination, or in fact, what are the additions and what are the deductions that we have to make for the purpose of coming into the book profit here, because the computation of the book profit is very much important. Unless there is a book profit has been computed, and there is a lot of litigations on how to calculate the book profit here. Now, first part is that starting point is that company covered shall prepare the balance sheet financial statement according to the Schedule 3 of the Companies Act 2013. If we are preparing the Schedule 3, that we have to follow the Schedule 3 of the Companies Act 2013, and based on the Schedule 3, we have to prepare the books of account, annual financial statement, and we generally do, and we are also doing for every company we are preparing, we are following the Companies Act here. In some of the cases, we have to follow the Ind AS. So there is a special section that where the Ind AS has been followed, how to calculate the book profit. It says that while preparing the annual account, accounting policies, accounting standards, and method and rate of calculation of depreciation shall be the same which was adopted for the purpose of annual accounts AGM under Section 129. So that these are the methods which are the accounting standards, accounting policy that we have to display, that we have to disclose, that should be the same, and for the purpose for which the accounts has been prepared for the AGM. This means it says that the accounts which were prepared for the purpose of AGM, for the purpose of the presenting before the shareholder, that account statement will be the origin point for the purpose of discussion or the purpose of the permutation and for the purpose of addition and subtraction to calculate the book profit as per the 115 GB. It also says in some of the cases the financial year is not the same as we follow. Like we follow from 1st April to 31st March. In some companies they follow December calendar year. In some companies they follow the October to October, like in some company. Then all this method has to be seen for the financial year. We have to apply this method on the financial year basis here. Adjustment in the book profit. What are the adjustments that we are supposed to make the book profit? Mind it, this adjustment that I have mentioned here, I have tried to cover all, but it may have omitted some of the few adjustment here. So this adjustment, this amount of the adjustment is not an is not an exhaustive leaves of adjustment. For the purpose of exhaustive leaves, we must go through the statute here to understand what are the how to calculate the book profit. So we will start from the profits which is shown in the balance sheet of profit loss. If profit and loss account is profit and loss statement, and from the profit and loss statement, first we will increase the profit will increase. What they will increase? Income tax paid or payable for any provisions. What are the income tax that is paid or payable? If the company is paying dividend distribution tax, if the company is paying, and if the company has paid any taxes, then dividend distribution tax, along with the interest, along with the education cess, along with the secondary education cess, that has to be added back for the purpose of the calculation of the book profit. Amount transferred to the reserve account. If the amount, if some certain amount has been transferred or it has been debited to the profit loss account for the purpose of transferring to the reserve account, that amount has to be reduced. That amount has to be extracted. That amount has to be taken care of, because that amount has to be added for the purpose of calculating the book profit. Amount set aside for the contingent liability. If the liability is not sustained here, so if some amount is, if amount which has been given a provision to say that certain unsustained liability, then this amount should also be reduced, added here in the profit here. So this will be added back here. Provision for loss of subsidiary company, if any. If some company has put the loss into the profit into the profit and loss account, then that amount has also to be added back here. Amount paid as dividend or the proposed dividend. As I mentioned, that if the amount posed as dividend is coming into the profit account, if coming, then it should be added back here. Expenditure related to the income covered under section 10. If some income which is if there is an income which is covered under section 10, then expenditure in corresponding to that income should be added back for the purpose. Added back means this excluded for the purpose of calculation of the book profit. Expenditure relatable to the income of another AOP or BOI which is covered under section 86. We know that if there is a AOP or the BOI there, and we have incurred certain expenditure on on account of that, then that expenditure should also be excluded for the purpose of computation of this book profit, because AOP and BOI will be separately taxed here. So what we are doing, we are removing the expenditure also, and later on we will see that we will removing the income also, so that should not cover into this part. Notional loss on transfer of capital asset, if being the share of SPV of a business trust covered under the clause 17 of section 47, or a notional loss of carrying out the amount of unit covered under 47. These are just a few of the illustrative lists. These are not the complete exhaustive lists. The point that I'm trying to say, what are the items that should be excluded for the purpose of calculation of the book profit? The book profit itself, a book profit has to be determined for the purpose of the chargeable applying the MAT provision, for the applying the MAT rate of 18.5% or 15% that is there. So we have to calculate the book profit, and in calculation of the book profit, the origin point, the starting point is the book profit which has been prepared as per the Schedule 3 of the Companies Act, or the book profit which is prepared as per the financial statement of the company which has been drawn as per the Schedule 3 of the Companies Act. And from that we have started, and after the starting we are trying to find out each of the item, like amount paid as a dividend, amount paid as a tax, amount paid which is related to the amount of expenditure which is covered, which is covered, and for which the income is subject to subsection 10. So these are the income, these are the expenditure that we will remove, and in fact that will be added back for the purpose of that calculation of the business profit here, a book profit here. And one of the part is expenditure related to the income of another AOP. We will remove the expenditure also, we will remove the income also, and then we'll find out whether that is covered or not here. Whether how to, whether this is the computation mechanism. Notional loss on transfer of capital asset, yes, notional loss will also be added back, or SPV, or the clause notional loss on transfer of capital asset being share of the SPV, or a business trust covered under the clause 14 of the 47, or a notional law carrying amount of the unit will also be added back for the purpose of the book profit. Amount of expenditure reflected to the patent covered under 115 BBF. Last time we have already discussed, this is a special provision for the purpose of a company which are engaged in the development of the patent here, and these patents are registered in India. If these patents are registered in India, there's a special rate. There's a special rate that applies to that part. If this is the part here, the company, the expenditure which has been done, and similarly the income which has been received, that has to be taken out from the profit loss account for the purpose of amount of depreciation, that will be the amount of deferred tax, amount of depreciation, whatever the depreciation is there as per the company, we will take away. Amount of deferred tax which has been debited, that has to be removed, that has to be added back for the purpose of book profit. Amount set aside for the diminution of the value of any asset. If any asset which has been demonized here, there is no value of that part, or we have kept some amount in, we have debited some amount in the profit and loss account, that this amount has also to be added back here. Amount standing on the revaluation reserve relating to revaluation assets on the retirement of the disposal assets. So if we have created some revaluation reserve related to the revaluation of the assets on the retirement or disposal of the asset, then amount has to also to be added back here. Now, with this, we have reached to a level that from the starting, we started from the income, what is the profit as per the books of account, and we have added certain income here. We have added back certain expenditure here. Now, when we have added back certain expenditure, we have reached to a figure, and after that, we will deduct whatever the amount will deduct. These are the amount that will deduct. Amount of income tax on which the provision of section 10 applies. If there are certain income which are on the credit side of the profit and loss account, here that we will deduct that amount of which on the provision of section 10 apply. This means this income should not be part of the total income. So we can recall that this time we are removing the expenditure, removing the income, and earlier we have removed the expenditure also. So we are removing that income as well as the expenditure which is subject to the cover under section 10. We know that there is a lot of issue on the section 14A. This this is coming from the consequential provision of the 14A itself here. Depreciation taking the rate of the income tax and excluding the depreciation of the revalued asset. We will calculate the depreciation as per the rate which as per the amount and as per the value which is coming as per the Income Tax Act, and we will apply the depreciation, excluding the depreciation on the revalued assets. Revalued assets depreciation will not be given. Amount created to the profit loss account withdrawing from the reserve. If some amount which has been created from the profit loss account, that should be reduced here. What we have discussed in the earlier slide, that if some amount has been debited to the profit loss account on account of the creation of some reserve, that amount should be added back. And here it also says if some amount is created to the profit loss account by debiting to the reserve account here, then you will find that this amount has to be removed here for the purpose of calculation here. Amount of income being the share of the SSC in the AOP BOI. Last time we have seen that expenditure was already reduced here, added back here. So we are trying to say income we are also reducing here. Any notional gain or transfer of the capital asset being the share of the SPV that we are reducing here. So these are the few items, in fact, not exhaustive list. I will come. Notional gain resulting from the charge of carrying amount of unit covered under the 4717. We have already discussed the notional loss. We have already added back. So now we are deducting the notional gain resulting from the change in the carrying amount of the unit. Gain on transfer of unit covered under the 4717. We are also reducing this part. Amount of income by way of royalty. What we have discussed that earlier slide, that the amount of expenditure on account of royalty was added back here. So amount of the income on account of royalty, which is covered under 115 BBF, is also reduced here. amount of unabsorbed depreciation or loss brought forward. What are the unabsorbed depreciation or the loss brought is also reduced here. Amount of deferred tax if it is credited to the PL. These are the things. If deferred tax, then we have to reduce it. Now, if we have reduced, then we have come to a figure, and on that figure we have to apply the 18 point, 15 point rate, the rate of 15% that is to apply. So that is called the on which amount, and that amount will be deemed to be the total income for the purpose of the charging the taxes or application of the tax rate here. Amount of income tax, amount of DDT under 115O or the distributed under 115R of the interest charged on surcharge education. So what we have discussed till now, that we have, that first part we have discussed, that what will be the amount of income tax that has to be added back here. So what is the meaning of the income tax? Income meaning the amount of dividend distribution tax under 115O or the distributed income on 115R that has to be added back, or the interest charge or the surcharge education says that whenever we talk about the income tax, this means it is including the surcharge education says and secondary. We have already discussed the foreign company will only include who has the P in India. Yes, foreign company who has the P in India, that will be included. But yes, if the foreign company is engaged in 44B, like we have discussed about the 44B, is about the special company, 44BB, 44BBA, 44BBB are out of the G115JB. So these are the provision where there are the presumption basis taxation is there. On the net basis there is taxation, and we can say that these will be out from the net of the, they will out from the 115JB. Company whose financial statement are prepared as per the Ind AS. So whatever that we have seen that these are the prepared as per the financial statement. But if the Ind AS is applicable, then necessary adjustment has also to be made as per the Ind AS. The book profit of the year of convergence and each of the four financial previous years have been increased or decreased by 1/5 of the transaction. So it is not only that previous year, but the last 5 years is also adjusted in order to achieve what is the book profit. What will happen if the company is amalgamated or demerged, and if due to this amalgamation or demerger, there is a the book value which is coming into the balance sheet or the in the profit loss account is not a book value, then we have to recast the balance sheet of the or recast the profit loss account of the resultant company, and then we have to calculate the book profit of that part here. Where there is an increase in the book profit the previous year due to income of the past year, including the book profit due to the APA. Yes, if any case there is a APA which has come, if a company has entered into the advanced pricing agreement, or if there is an adjustment on account of Section 92 CE, that is called the secondary adjustment. If there is a company which has the entered into advanced pricing agreement, or the secondary there is a secondary adjustment, then in that case also the book profit has to be recomputed, and for this purpose the SSC has to approach to the assessing officer for the purpose of recomputation of the book value in order to pay the MAT here. CA certificate in the form of 29B, we know that there is a rule 40B which talks about that there should be how the computation has been done, and we can go into that part to understand these are the method that we have to follow. It shall not apply, as we have discussed, that it shall not apply to the companies carrying on business of life insurance. Yes, it is a business of life insurance, and those companies which are covered under the newly section 115B AA and 115BAB, where the special rate has come for the purpose of the company. So these are the special category of company that will not apply. The MAT will not apply. Company having a unit located in the IFSC, this means International Finance Service Center, that is there, that is the gift city that we generally call, and derives the income solely from the convertible foreign exchange, the rate of 15% will be reduced to the rate of 9%. So because their income is totally on the foreign exchange, convertible foreign exchange, so therefore they have to pay the reduced rate, and that will be 9% will apply here. If that is there, Now we have seen the computation mechanism of the book profit, and on the book profit, the rate that will apply. Now with this rate, we can see that even if a company is in a loss, if the company is not a tax payable liability, the company has to pay the tax as per the 115 GB, and that is called the minimum alternative tax. That is the AMT, sorry, minimum MAT here. If that is the MAT here, then what will happen? They have to pay the tax here. If they have paid the taxes, then how they can get the credit of the tax here? Because it was not a total income, where this book profit was deemed to be a total income for the purpose of application of the tax rate and for the application of the payment for the payment of tax. Then these taxes that which have been paid extra or in that is excess of the net tax payable, that tax payable that is available for the purpose of credit in the subsequent year, and that credit has to be given in the 15 years. So we have a time span of 15 years. Within the time span of 15 years, we have to get the benefit of the 115 the tax which has been created here, credit of the tax here. So it says that tax credit is to be allowed, that the tax credit to be allowed shall be a difference of the tax paid by any financial year, that is 115 JB, one, and the amount of tax payable by the SSC computed in accordance with the provision of this Act. No interest will be allowed on that part of the credit. So if that is if the excess amount which is payable, which has been paid by the SSC, on that excess amount, there can be some credit. When the credit will take place, when the actual tax liability is more than the MAT liability in that year, that credit can be taken. And we have to be sure that first when we are availing the credit of the previous year MAT here, try to avail the credit which was the latest, which was the oldest one. So oldest one for credit should be taken here, because we have the limitation period, and limitation period says that after the span of 15 years, the credit cannot be taken here. So we are the can be taken. It can be carried forward and set off up to the 15th year that we have discussed here. Yes, some amount can be discussed, set off to the extent of loss, and the total amount and tax which should have been payable under 115 GB. Company converted into the LLP, if the company is converted into the LLP, then they will lose the benefit of it. These are the provision which are subject to quite a litigations here, because if the company which has paid the MAT here, or which has paid the AMT, and they are if they convert themselves from the company to an LLP, then they will not be getting the benefit which they have been used to get it here. So quite litigative provisions here. I'm not going into the litigation right now. I can go, but yes, for the purpose of our discussion, I'm refraining from right now on the discussion of going to the litigation that can be arised here. Our next section is 115 JC, that is the alternate minimum tax. We have seen that MAT is as per the liability which is for the purpose of companies. The computation mechanism of the MAT is a bit different. However, the computation mechanism 115 JC talks about the AMT, that is called the minimum alternate minimum tax, and this apply for a SSC which are other than company. So those SSC which are other than company, for that rate will apply. And what is that part here? It says that person other than company, when the tax payable is less than AMT. So what is the AMT? We have to understand that part. It should be calculated under adjusted total income. We have seen that total. We have seen the book profit there. Now it says that you calculate the adjusted total income, and adjusted on the adjusted total income, you apply the rate is the same. Rate is the same, 18.5%, and if that is there, then ATI will be deemed to be the total income of the SSC here. And here the SSC is a non-corporate SSC. So ATI will be the total income before giving the adjustment of the deduction. And how to calculate the ATI? ATI, for the purpose of calculation of the ATI, what we have to do? We have to exclude The total income, ATI will be the total income before giving the adjustment of deduction under Chapter 6. So we will not be able to give any deduction under Chapter 6 other than ATP. So if there is amount which has been paid under ATP or deduction under 10 AA, 35 AD, that we have to reduce for the purpose of, that we have to remove for the purpose of calculation of the AMT, and after that AMT has to be calculated. CA report in the form of 29C will apply. It will not apply if covered under 10, 115 BAC or 115 BAD. BAC is for the purpose of individual, the special rate, individual and HUF for the purpose the special rate has come, and 115 BAD is a different provision which talks about the cooperative society. Access of AMT. If we have paid the AMT, we have prepared the AMT, then we can go to the access of the AMT, pay, and that income access of the AMT over regular income tax payable shall be allowed to take credit if the amount which has been paid as an AMT over the regular income tax payable, there is a definition of the regular income tax payable, and that for which we can get the credit part also. If any in any segment here where the regular income tax payable exceeds the AMT, so this means if we calculate in a year, we calculate the income, and after that we apply that yes, regular income tax payable. This means we have to apply both the method, regular income tax and as per the AMT, and we find that the tax liability is more than in the regular method. Then what will apply the difference between the AMT and the regular method. For that part, the credit can be taken, and it is better to take the credit from the oldest one to the latest one here. No interest payable in such credit. Yes, carried forward till 15th assessment year. Not applicable in the 100 years BSc, 115 BAD. We have already discussed the 115 BSc talks about the special rate of taxation of the individual, and the HUF 115 BAD talks about the special rate for the purpose of cooperative society. Since these are the non-cooperativity, so therefore it says that by way of the 115 B, 115 JC as well as the 115 JD will not apply. In case of individual, in case of adjustment, if there is adjustment on account of 144 or 147 or 263 or 264, such variation will also not apply to the credit of the carried forward amount here. These are the few things that we have to learn from the purpose of the 115 JP and so on. With this, I am completed first limb of that our discussion. Yes, I am running through it. I know that there is a bit fast I have to run here, because the most important thing that we will be discussing on the issue of the taxation of the corporate entity, and when we will discuss of the taxation of the corporate entity, taxation of the trust here, and then we will, if there is any question, then we can take it here. Before this, this is the about the non-resident Indian NRI. Non-resident, who is the non-resident Indian? I am coming to the link third here. I will come to the taxation of the trust subsequently. Who is the non-resident Indian? Non-resident Indian has been defined into the FEMA also, but generally understanding is those person who are the citizen of India and who are the person of Indian origin but are non-resident. If we see the Income Tax Act for the purpose of individual, it says that there should be, for the purpose of what is the Income Tax Act, it is the residential status section 6. It talks about the resident as well as the, if a person is resident. If the person is resident, if the definition of the resident has been given, the individual will be resident in India if first condition is that 6(1)(a), he has been in India for 182 days or more in the previous year. Second condition is that in the last 4 years, in the last year he was in India for 60 days or 365 days in the 4 year previous to the last year, or previous to the in the 4 preceding previous year. So these are the periods, or these are the condition which makes you a resident. If the condition is not satisfied, then you will become a non-resident here. So the important point is that is there. The section 6 defines that when you are a resident, it does not define the non-resident. The term non-resident has not been defined. Only thing that we have to understand that non-resident term, which is negative to the resident, and if a person, which since the resident had been defined, if the condition of the resident has not been followed, then the second fallback is that the ultimate fallback is that a person is a non-resident here. However, for the purpose of individual, there is a small relaxation has been given. A person can be resident but not ordained resident, and not ordained resident. So these are the things that can be imputed in between. I'm not going to do this part, but it says that if a person is a non-resident Indian, yes, if a person is a non-resident, this means if the person is non-resident, then a scope of the total income, the 5(2) will apply. In the 5(2) will apply. For this purpose, the computation mechanism is a bit different here. Then the issue will arise here. The 5(2) will apply. Now the next part is that if it's a non-resident Indian, certain income of the non-resident Indian, which are been acquired through an asset, which are called the foreign exchange assets, on that exchange, then on that income, the amount will be the income will be exempted from the tax. Means if there is a non-resident means who are the citizen of India or the person of India, but they are non-resident and they have invested in India into the specified securities, specified assets, or specified assets means share in the Indian company, or the debentures, or the deposit, or the security of the central government, or any other government. If they have invested into the specified asset, and this investment is called the foreign exchange asset, means this investment has been made by way of bringing the foreign exchange into India, and they have purchased the assets or subscribed the asset, or they have acquired the asset through by subscribing in the foreign exchange. So the non-resident Indians who have invested into the specified security by purchasing this specified security or investing in the foreign exchange, this means India government has got the foreign exchange. Since the foreign exchange is a valuable assets, now for this purpose, certain benefit has been given. What the benefit has been given? It says that if certain income has arisen on the specified assets, then income will be non-taxable here. And if there is a capital gain on account of these specified assets, we can see that there is a provision. We say that if the capital gain amount has been invested into India on the specified assets, or the asset which the government will notify, then it will also be not subject to taxation under the 45 section 45. This means the capital gain will also not cover here. Let's see before going to the. So for the purpose of non-resident Indian, there is a income, and what is the income? Income is from the capital gain. Capital gain on transfer of foreign exchange assets. If the assets, foreign exchange assets mean specified assets which has been acquired by the non-resident, by way of non-resident through the foreign exchange. This means the foreign exchange has come to India. What he says, if the SSC being NRI, so the first point is that SSC being a NRI, this means the SSC is an individual, and if it is SSC individual, he is a non-resident. Non-resident means he, first of all, the SSC should be an individual, the SSC should be a citizen of India, or the SSC should be a person of Indian origin, and after that he should be a non-resident Indian. He should be, when he will say that he is a non-resident Indian, this means he is not a resident in India, but he is a non-resident. He is a non-resident. So we have to understand the term NRI, and the NRI has also been discussed in the part of the FEMA here. But here for this chapter, NRI has already been defined here. Long-term capital gains, if there is a long-term capital gain from the transfer of foreign exchange assets or the original assets, and after that, within 6 months of the transfer, invested in the whole of the part of the amount in the new consideration or of the net consideration in the specified assets or the saving certificate that is new asset. So first, let's see here there is a benefit of to the non-resident Indian. It says that if there is a capital gain from the transfer of a foreign exchange assets, then that capital gain will not be covered under Section 45 for the purpose of computation of capital gain, provided first condition says that these capital gain which has just arises, this capital gain, it talks about the net consideration. It does not say about the gross capital gain. It's about the net consideration. Net consideration means consideration minus certain expenditure for that purpose. So net consideration should be invested, should be in fact reinvested in where should be reinvested within a period of 6 months. Where if they have to invest, if the investment in the new asset is not less than net, where they have to within 6 months they have to invest either whole or in part of the net consideration in the specified assets, whether you again invest in the specified assets or the saving certificate, and that called a new assets. So there was an original assets and there is a new assets. Original assets has been sold, there is a capital gain on account of that part, and new asset has been acquired. Take a case, there is a capital gain, but the no new assets have been acquired, then this amount will be subject to Section 45. But if the capital gain is there, the net consideration is there, and this amount has been rolled over for the purpose of investment in the specified assets, then that amount will be not subject to the Section 45. This means the capital gain computation will not arise to the extent of the amount which has been reinvested in the specified assets or the saving certificate. If part of the amount has been invested, we have to apply the proportion test, and which is the last bullet point here. We say that capital gain that will multiply by the cost of the new assets divided by net consideration. So to the extent of the new assets, that amount will be exempt under that amount will be not subject to tax. Rest will be subject to tax. If the income is from the non-specified security, it says that where the gross total income of an NRI includes income from investment locking of assets other than specified assets. So if the income is not specified assets, when we say that either other than specified assets means, first of all, they are not falling into the 5 category of the investment, they are the securities here. And second point is that these assets are not acquired through the foreign exchange assets. If it is not acquired through the foreign exchange here, then the rate of 20% will apply, that is there. And if it is a long-term capital gain, the 10% rate will apply here. Rest, if there is a rest part, if there is any other income, then the normal rate will apply. If that is the condition, here, then it says that if the income is falling under this chapter for the non-resident, then the government says that I will give relaxation. What relaxation says that? It says that no requirement of filing the income tax return. Don't file the income tax return. Why? Have to satisfy only 2 conditions. That the income, if the income is only the investment income and long-term capital gain, or both. If the income which the non-resident NRI is subject to tax in India is only the investment income or the long-term capital gain, or both, that is the first condition. And the second condition is that TDS on that income has already been deducted as per the provision of Chapter 17B. So if the income which is there, only those income is there, what is the investment income from the investing in, if there is an investment income, if there is a long-term capital gain, not the short-term capital gain, if there is a long-term capital gain, and on that part, on that part, tax has been deducted as per the Chapter 17B, so no need to file the return. However, these provisions are like complete chapters. This complete chapter is not a mandatory chapter. The non-resident Indian can give a letter to the AO saying that I do not want to be covered under this chapter, and I should be covered as per the normal provision of the Income Tax Act. And if it is a normal provision of the Income Tax Act, then the whole method will be applied as per the normal provision. This method will not apply. Even if a person who has opted that person says that no, I will be covered under the chapter 12, then even if that person come back to India, or this person when he come back to India, he can claim the benefit, and this benefit will be roll on, even considering that even though that person was a non-resident, the condition was that this amount must have been invested through the foreign exchange when he was out there outside India. Before going, so I have hurriedly covered the issue of the. I want to keep last 15 minutes for the purpose of our Q&A. Now, coming to the income of the trust here. For the purpose of understanding the trust here, what is the important part is that I'm just removing the slide here, and I'm trying to be here. For the purpose of understanding of the income from the trust, what is important point is that there should be a trust. Means when we say that there should be trust, then there should be a settler who is the creator of the trust, and we also call him the author of the trust. If there is an author of the trust, then he wants to create a trust. The trust can be created by way of entering into a instrument through which the trust author bequeathed his property or bequeathed his asset in favor of the trust here. So one trust is a fiduciary capacity for the benefit of the others. So the beneficiary will be different here. I have bequeathed my property. When I say that bequeathed my property, this means the property which has been transferred to the asset trust here, or this transfer is irrevocable transfer, means I cannot claim back. I cannot say that yes, I have transferred the asset, but the income will be there with me. And the answer is no. Income, that even I will say that transfer has been done, along the transfer should be done along with the income also. So therefore, when a trust is created, the settler bequeaths his property, or this property that is there, or this property becomes the property of the trust property, and after that there is a trustee. Trustee is also a fiduciary person who is managing the trust, and who is the responsible for managing the trust, but it does not is the beneficiary. The beneficiary is someone else, like it can be some private person who is the beneficiary, or some public person can be, or public can be the beneficiary. If a person is the public is the beneficiary, means it is a public trust, means public at a large is beneficiary, like Delhi Public Library or anything, like we go to any temple. This temple is a trust for which anyone who is the public at large is the beneficiary. Anyone can do some work here, or if we try to distribute some, or we take some. There are lot of libraries, lot of institutions are there which are under the public trust. These public trusts are for the common good of the public at large, and therefore these are called the public trust. Private trusts are those trusts which are generally a specific trust. A specific trust means you know who are the beneficiary. This means a trust has been created, and this trust has been created for the benefit of a particular person or the particular group of person. Particular person or particular group of person. This person may be the unborn person also. Maybe the unborn person also may come into existence after a certain period of time. Till that time, there will be some executor will be for this purpose. There will be some other person here. So we can say that yes, a trust can be created, and a trust is created by the settler or by the author, or you can by the author. And when the trust is created by the author, the property, he transfers certain property or transfers certain property, and this transfer is irrevocable transfer. And when this transfer irrevocable transfer to a trust here, this is a this is not covered under the section 47. This is not covered. This is covered under the section 47, and therefore it is not a transfer in terms of section 45. Now, when there is a trust, for the purpose of taxation of the trust, there are two things that we have to understand. Whether it is a private trust or it is a public trust. Yes, we have to understand the public trust. And if it is a discretionary trust or it is a non-discretionary trust. When we say that discretionary trust means discretionary trust comes when there is a discretion, when is a discretion by the trust or the management of the trust to distribute the income from the trust to the beneficiary. If there is a discretionary trust, then this income will be taxed in the hands of the trust itself at the MMR rate, that is the maximum marginal rate. However, if the income is, if the taxation, if the trust is not a discretionary trust, means the management trustee, the management or the trustee does not have any discretion to hold the income of the trust at the trust level. It has to be mandatorily, it has to be compulsorily, has to be distributed among the beneficiary in the same previous year. Then we can say that these are the trust are the pass-through entity. They do not hold back any amount of income. They have to pass on the amount of income. And in such a case, the nature of the income which has arisen to the trust, that will be same nature of income that will be applicable to the beneficiary. So understanding part that is that whether the trust, first of all, in when we approach for the purpose of taxation of the trust, we try to understand whether the trust is a private trust or it is a public trust. If it is a trust, is a private trust or public trust, then we say that if it is a specific trust or non-specific trust. A specific trust means where the income, where the beneficiary is already known, and the percentage of the profit or percentage of the right in the asset property is also known to the in advance. Here I will say that it in advance, because we know that what percentage the rate will be distributed here. When we come to that, whether the trust is a discretionary trust or a non-discretionary trust, the charging of the taxation of the taxation trust will depend upon the factor whether it is a discretionary trust or it is a non-discretionary trust. If it is a discretionary trust, this means it is a discretion. If it is discretion to, it is a discretion to pass on the benefit to the other, to the trustee here, to the beneficiary. But if it is not passed here, or if even though in case of discretionary trust, the income has to be taxed in the hands of the trust itself, in the hands of the trust itself, and after that income, that beneficiary, that amount of the income, that has to be distributed to the beneficiary. However, in the case of the non-discretionary trust, the taxation has to take place in the hands of the beneficiary directly, because here the trust is not, the trust is a pass-through entity, and therefore the income will be taxed in the hands of the beneficiary in the same nature as the income that would have been arising into the trust itself. As we have discussed that the residential status of the trust will be different, because the residential status of the trust is dependent upon the residential status of the trustee. The trustee may be a single trustee, or the certificate or the trustee will be the board of trustees. If the trustee is a single trustee, then the residential status of the single trustee will determine the residential status of the trust also. But if it is a non-individual, it is a group of the individual who are managing the trust. This means there is a committee who is managing the trust. Then we have to see where the place of where the controlling, who is controlling the trust, whether the trust is fully controlled or fully, if it is controlled fully from outside India, then we can say that this trust is also a non-resident trust here. So therefore, the residency of the trust as well as the non-residency of trust is dependent upon the fact or the place of effective management, where the place of effective management is situated. If the place of effective management is in India, then we can say yes, it is a resident trust. When the place of effective management is not in India, then we can say that that place is the residence, is the trust is a non-resident trust, and if the non-resident trust will be there, then the law will be applied differently. Now coming to the other part here. So we have broadly understood the residential trustee. We have understood the part of the how the taxation is there. Another issue is that there is a representative SSC is there. The trustee is also a representative SSC. Why he is a trustee is a representative SSC? Because ultimately the tax has to be, it is the beneficiary in whose favor, it is the beneficiary who has to pay the tax. But here, since the taxation is the trust is a discretionary trust, this means the income is holding at the trust level itself, at the first level itself, then and that is being represented by the trustee. So therefore, the trustee will be the representative SSC. And for this purpose, we have section 161. If I can go to the law here, we can find out that what are the section 161 talks about the representative SSC. Representative SSC means, for the purpose of this act, representative SSC means in respect of income of non-resident, in respect of the income of a non-resident, in respect of income of a minor, lunatic, or idiot or guardian, in respect of income which the court of wards or administrator, in respect of income which is a trustee. It says that, come to section 160, it says that for the purpose of this act, representative SSC means in respect of the income which a trustee appointed under the trust declared by the duly executed instrument in writing, whether testimonial, whether testamentary or otherwise, including any work deed which is valid under the Muslim Work Validating Act, receives or entitled to receive on behalf or for the benefit of any other person, such trustee or trusts or trustees. So all the trustee, whether the trustee is a similar person or whether the trustee is a more than one person, that is a plural person. So the trustee will be a representative SSC, and this representative SSC will be taxed as if he is as if his income, and for this purpose, the trustee will be the representative SSC. So most important thing is that a trust, understanding of the trust should be like this one. If there is a trust, there is a trustee, there is a beneficiary, and if there is a beneficiary party there, then the trustee will be taxable here, and trustee will be taxable as the representative SSC, and as a representative SSC, he will be subject to, if there is a discretionary trust. If it is a non-discretionary trust, means the income has to be passed to the beneficiary, then it is the beneficiary who will be liable to pay that tax. That is the point. We generally come across the section 11, section 12, section 11, section 12, section 12A. It says that if the trust is there, but these trusts are charitable in nature. When these trusts are for the purpose of charitable purpose. The term charitable has been defined under section 2, subclause 13, I feel that. And the charitable has some different objective. If it is for the purpose of relief to the poor, if it is for the purpose of education, if it is for the purpose of extra thing which is being mentioned in the section. Just go to section 213, we will find out what are the purpose we can create the charitable purpose. It defines only charitable purpose. If it is charitable purpose, then this trust says that since my objective is to charitable, this means I'm not trying to, my objective is trust is charitable, means I'm not trying to make the profit here. And if that is the purpose, it says that your income will be not be part of the total income, provided there are certain conditions which has been satisfied. Means whatever the amount that you have received has been invested for the purpose of the charitable purpose here. The charitable purpose should be in India. If this is the purpose which has been invested in India, and if you are not able to invest, you can invest it, you can expend up to 85%, and rest 15% you can carry forward. So these are the for the purpose of that. Actually, taxation of a trust is the taxation trust is totally a different topic here, but these are the topics. Section 11, 12, 13 is for the purpose of charitable trust. So first of all, we have to understand the trust. If the nature of the trust is that, what is the nature? And these charitable trusts say that they will not distribute the income. So therefore, they are calling themselves as a discretionary trust. With the and when it is a discretionary trust, then the income will be taxed in the hands of the trust here. But the trust is a fiduciary capacity. The trust will be taxable. But who is the representative assessee here? The trustee is the representative assessee. A trust is taxable in the nature of the trustee here. The point that you're trying to say, that the trustee will be the representative assessee, and he will get all the rights like a what the right will given what the right will be given to the beneficiary. So when section 160 subsection 3 is important, it says that in respect of income which a trustee appointed under a trust or declared by the duly executed instrument in writing. So first of all, in respect of income, it says that in respect of the income, it is not about all the income. You have to mention that in respect of the income, which are the income, which a trustee, yes, they are trustee, appointed under a trust. There should be a trust who is appointed, declared and duly executed instrument. So therefore, for the purpose, instrument is necessary. What are the instrument which creates the trust? These are the terms. Whether the trust can be created by will, yes, the trust can also be created by will. So these are the duly executed instrument. The trust, the instrument should be duly executed. We have to go to the charity or commissioner of charity like Bombay. Here we have to see that who is the person who is the equivalent to the charity or commissioner, and there should be an instrument here which should be executed here and in writing, and whether testamentary or otherwise, means by declaratory or otherwise, including the work deed, and which is valid under the Muslim Work Validating Act, receives or entitled to receive on behalf of or for the benefit of any person such as trustee or trustees. So they are saying that they are this income they are receiving as a trustee, as a fiduciary capacity, but on behalf of the benefit of any person here. So these are the beneficiary here for these purposes. And there is explanation. Explanation just says a trust which is not declared by the duly executed instrument in writing, a trust which is not duly executed by writing, including any work deed or the valid or which is valid under the Musliman Work Validating Act, shall be deemed for the purpose of clause 4 to be a trust declared by the duly executed instrument in writing if a statement in the writing signed by the trustee or the trustee sitting about the purpose of the income or the purpose of the trust, particularly to the trustee or trustee, the beneficiary or the beneficiary, and the trust property forwarded to the assessing officer. These are the few conditions which I am not going to detail now. My task was that given that I should discuss about the writ here or writ and invit here. Writ and invit are generally the special purpose vehicle which are created as a trust. But in this case, the unit holder, there are a lot of unit holders which subscribe to the unit of the trust. And this, when they subscribe to the unit of the trust, it is the trust who has the accumulated fund, who has the fund, and these funds are being invested as per the permitted activity of the REIT. Means some of the infrastructure fund, some of the infrastructure facility which are going on, some of the toll plaza, some of the road project, some of the big project here. So REIT on the REIT right now, the FDI is totally allowed. FDI is totally allowed on the REIT part here. On the important part is that the income which the REIT will derive, that income will be distributed to the unit holder, and the income of the unit holder will be the same nature as it was the income of the REIT. So the real estate investment trust, as well as the infrastructure investment trust, these are the trusts where there are unit holders. These unit holders, and these are the first of these are the non-discretionary trust. Means the income has to be passed on to the unit holder. When the income has to be passed on to the unit holder, who will be taxable? It will be the unit holder will be taxable. If the unit holder taxable, the unit holder may be in India or maybe outside India. The REIT, that REIT, since it is issues the unit here, so it is being guided by the SEBI also. So REIT is being monitored, or it is being regulated by the SEBI here. Now the second point arises here, the income of the REIT. Whatever the income of the REIT will be there, he has to pass on the income to the unit holder in the same line, in the same nature of and therefore the income of the unit holder will be of the same nature here. So we can say that one point that we can say that REIT is a trust. Yes, it is a trust. It is created by the fiduciary body, where is a separate body. The REIT is a trust. The trust is governed by the Indian Trust Act. The REIT, in the case of the REIT, it is a non-discretionary REIT. The non-discretionary trust means the trust income of the trust has to be passed on to the unit holder, and the unit holder will be liable to tax on those income, liable to those on income. These are the few understanding. And if you go to the section 115 UA, which is the 115 UA, which covers this part here. A special provision related to business trust, that is the business trust is a REIT and the entities are the business trust. It says that notwithstanding anything to the country contained in the provision of this, the distributed income, the income distributed by a business trust. So what they are distributing the income. They are not saying that it is a dividend. They are not saying that it is a dividend. So they have to distribute the income distributed by the business trust to its unit holder, to whom they are distributing unit holder, shall be deemed to be the same nature. What to say is that the nature of the unit holder, the amount which reaches to the hands of the unit holder, will be the same nature. This means if there is a asset on which the REIT has got the rental income, so the rental income, when will be distributed, it will be in the nature of the rental income. It cannot change the character here. Similarly, if the income is in the nature of business income, so it will be the business income that will pass on to the unit holder. The same nature of income and in the same proportion in the hands of the unit holder. So based on the proportion as it and as had been received or accrued to the business trust. So whatever the business trust has received the income, that will pass on. Subject to the provision of 111A and 112, a total income of a business trust shall be charged to tax at the minimum marginal rate here. So if there is a capital gain, subject to the provision of that part, if there is a capital gain part, then they will be subject, if there is a certain amount they have retained here, then they will be subject to the MMR here. And after that, if any previous year distributed income or any part thereof is received by unit holder from the business trust in the nature referred to in 23F or section, then such distributed income or part thereof shall be deemed to the income of such unit holder and shall be charged to tax. Yes, we have already discussed that it will be charged to tax in the hands of the unit holder. Any person responsible for making payment to the income distributed on the behalf of the business trust or to a unit holder shall furnish the statement. So the procedure part, then the unit holder has to submit the statement. So now we have considered mainly three parts here. Mainly first part was about the MAT and the AMT. Second part was about the NRI income. We have discussed the NRI part here. We have discussed that who is the NRI also, how the NRI has been allowed to invest in India, and can NRI invest in India? Yes, they are invest in India. There is a NDI rule, non-debt instrument rule, which governs the. Earlier, it was the FEMA 22, which says that what are the FEMA FDI for the purpose of the for the purpose of non-resident. Now it is a non-debt instrument rule. Non-debt instrument rule guides that which how the non-resident Indian can invest into the shares in India, and for this purpose. And another part is that section we have seen that 115 CDE, like these are the section which governs the income of the non-resident, and if the income of the non-resident is arising from the specified assets, and the specified assets means these few assets like government securities, shares of a company's debentures, if they have purchased these shares through the foreign exchange in India, then these are called the specified assets. And if the income is from the specified assets, then it says that it will not be subject to tax. If there is a capital gain, then if there is a capital gain income, then only there is a benefit of the rolling over is there, that can be rolled over, and the subsequent specified assets can be purchased. If that subsequent specified assets is sold within the period of 3 years, then the the amount and on the amount, the capital gain arising due to the subsequent sale of the asset will be subject to the Section 45 taxation here. The benefit of the rollover is there. The NRI, if they have the only investment income from the specified assets or from the long-term capital gain, and the TDS has been deducted, then they are not required to file the ITR. They are not required to file the ITR. The second issue arises here, whether this option, whether the filing, whether this rule to chapter 12 is an compulsory or mandatory, compulsory or the not compulsory. This means whether the mandatory part, and the answer is no. The NRI can opt by writing to the assessing option that they do not want to follow or they do not want himself to be covered under that chapter, and if it is not covered under that chapter, then income of the non-resident will be taxable as a normal computation. The third point arises here. If he opts like this one, then he is not required to file the return. And most important part is that this benefit of the chapter 12 will continue even if the non-resident Indians come back to India and he becomes the resident of India. We have discussed the taxation of the trust also, particularly REIT and InvIT. And in the case of the REIT and InvIT, we have also discussed what are the trusts, which are the discretionary trusts, which are not discretionary trusts. And if it is a non-discretionary trust, if the income is a pass-through, then if it is a non-discretionary trust, the REIT is a non-discretionary trust. If it is a pass-through, then it is a pass-through entity, then the income will be taxable in the hands of the unit holder in the same nature here. So the REITs and InvITs give that type of privilege here. Another important point that I wanted to discuss is the important section which has come here. Recently, there are a lot of charitable organizations which are losing their registration because they are not able to comply the provisions here. For them, there is a new provision has come. It is not a new provision here. I will go to the slide here. Let me go to the slide here. That is the chapter 12EB. This is the chapter 12EB, and it is a section called 115TD. This is a 115TD, which says that very much important part is that we say that where a trust which was registered under 12AA and 12A or 12B, which has converted into itself in a non-eligible, which has converted it into or not eligible to grant registration. We know that right now that every charitable trust has to renew their registration, renew their grant under 12AA, 12A or 12B. If they are not able to, what they say that if they are not able to get the license, which says converted into any form which is not eligible for grant of registration. So if the charitable trust has been converted into any form which are not able to grant the rest, which are not eligible for grant of registration under 12A and 12B, or it has merged with any entity, what is say that if it is merged with any entity other than entity which is trust. So if it is merged with any entity which is other than entity which is trust or institution which is registered under 12A, or he has failed to transfer upon dissolution. So on the failure on the transfer upon dissolution, all the assets of the other trust to any other trust. So if the charitable trust gets dissolved here and he failed to transfer upon dissolution all his assets, in what he said, it's all his assets, not the only assets, all his assets to any other trust or institution registered under 12A or 12AB, or any other fund or institutions, or trust or any institution, or other educational institution, or any hospital or medical institutions which are covered under Section 1023C within a period of 12 months after the date of deletion, then what will happen? Then, in addition to the normal income tax, what the trust will be paying, because he will lose the benefit of the 12A, but the normal income tax that the trust will be paying, he will be, in addition, he will be charged to the he will be charged to the taxation on the accredited income. What is the accredited income? This accredited income means total income on that part, accredited income that will there, and accredited income, and that rate will be the maximum marginable rate that will apply. The law defines what is the accredited income. Accredited income means income for the purpose of section 1 means the amount which is the aggregate of the fair market value of the total assets exceeds the total of the it exceeds on the specified dates exceeds the total liability of such a value of the institution computed in accordance with the method of valuation. So there is a special method of valuation in which the rule 70C 17CB has been prescribed, and if that is followed here, then in that case, what is the accredited income is there? On that accredited income, the maximum marginable rate will apply. However, there is a lot of combination and permutation is there for this purpose. It says that when a trust or institution shall be deemed to have converted into a form not eligible for registration, we have seen that when a trust, it says that when the trust will be not eligible for the registration. So say the deeming fiction also, that when the trust, when the registration granted to it under section 12AA or 12AB has been cancelled, we know that if the AO has cancelled the trust, a lot of cancellation is taking place. If the AO registration has cancelled, if the cancellation is taking place of the trust, then his income will be taxable under 112 and 115TD, and for this purpose, accredited income has to be calculated here. It has been adopted or undertaking modification in the objective which do not conform to the condition of the registration. So if there is a modification of the if the modification in the trust deed or the object which is not conformity with the certificate of registration, then it will again be subject to the 115 TD, or has not applied for the phase registration. If he has not applied for the phase registration, right now we have seen that we apply for the registration, we get a provisional registration, and after that there's a registration here. So, and the old registration, old trust has also to get registered here. So, if he does not apply for the purpose of phase registration, then it will be subject to the condition. Their income will be covered under 115 TD, or has filed the application for space application, but the said application has been rejected. But yes, if these are the conditions which is there, then the income of the trust, which was covered under 12A or 12B, we will deem that this trust is not eligible for the purpose of registration, and under that situation, his income, apart from he will liable to the income on the he will liable for the total income. He will be also liable to tax on the accredited income, and the accredited income is the difference between the gross value of the assets on the specified date minus the liability on the specified date, and on that amount the maximum marginal rate that will apply. And for this purpose, there is a different method of valuation has been adopted, and with this valuation is called, is mentioned in the rule 17CB. With this, I in my discussion here, it is already 5:50. I will invite for the purpose of question answer session. Sir, I'm open for the purpose of Q&A, sir. Chawla, sir, Garg, sir.
जी सर, क्वेश्चन आंसर ले ले सर अब।
Yes, yes, sir. I'm through with this my presentation, sir.
ठीक है सर, प्लीज सर। Sir, first question is from C. Atul Puri ji. Interest and dividend are very sensitive issue while arriving at the correct tax. Please clarify this portion.
Yes, sir. Puri sahab, you are absolutely right. Interest and dividend are very sensitive issue. Why the interest and dividend are very sensitive issue? Interest is taxable. Interest is taxable. It is taxable under the, first of all, for the purpose of taxability, we can go to the section 9 and we can find out that if interest is paid by the government or interest is paid by the resident, or if it is paid by the non-resident, then interest is taxable under the section 9 itself. The dividend is also taxable. The dividend was taxable, is also taxable under section 9. Now, for the purpose of interest and dividend, they are covered under section 56. Yes, they are covered under the 56. And however, there are different type of interest on which are being paid. And if it is covered under the, if it is income of a non-resident, it is covered under 115A. The TDS has to be applied accordingly. If it is covered under the different 194 LC, 194 LD, 194 194 section, the TDS rate has to be applied. Dividend is quite interesting topic. I would like to put more stress on the dividend. Now the dividend, the 115O is no more, so the dividend distribution tax is no more. So the person who is receiving the dividend has to pay the tax on the dividend. Now it is imperative that when a person who is receiving the dividend, he can himself pay the dividend. Earlier we used to say, earlier the department used to say that when a person, when a company has deducted company has deposited the dividend distribution tax at the rate of 18%, part of the 15% or 18%, then the recipient of the dividend are not supposed to pay tax. They were exempted from the paying the tax on the dividend here. Now that 115O is no more, so the person who is receiving the dividend, they have to pay the tax on that dividend here. For this purpose, there is a special provision under section under section 10, and there was another section was there where I feel that the cap of the 10 lakh rupees was there. 10 lakh rupees threshold was created here. I feel that, I'm not sure if I'm not mistaken. Another part is for the purpose of dividend. Another interesting part of the dividend is that if the dividend is arising in the hands of the non-resident, now whether the non-resident at the TDS stage itself can claim the DTA benefit, the answer is yes. The non-resident at the TDS level can claim the benefit of the TDS, can claim the benefit of the DTA. So this is the important issue, particularly the dividend and the interest. And most important part is that for the purpose of nature of the interest and nature of the dividend are both different here. We have to understand that dividend is the right which a shareholder gets when he contributes to the capital of a company or a capital into the capital. But whereas the interest is on account of the time value of the money, which is in account of the debt amount borrowed by the company or amount borrowed or the debt incurred by the borrower here. This means interest has been defined under section 2 also, that interest should be covered for the purpose of amount borrowed or debt incurred, whereas the dividend has some different limit, dividend A, B, C, D, E also. Yes, these are the four are very much important topic, and we should understand each of the topic thoroughly, both the perspective of the payer of the dividend and the payer of the interest, as well as the receiver of the interest and receiver of the dividend. And particularly the issue is more interesting when we say that the recipient is a non-resident here. If the recipient of the interest is non-resident, or that, then how to apply the DTA benefit for this purpose? If the interest is if the dividend is if the not if the recipient of the non in dividend is also a non-resident, how he can claim the benefit of the uh, DTA? Earlier there was a before 115.0. I can recall there was a India-Hungary DTA on which the dividend rate was something lower, and it was mentioned that, and it was one of the ITAT order which says that in the case of the, even though there was a dividend distribution tax was there, the rate of dividend, the rate of tax that will apply, that was mentioned in the DTA. However, after the 115.0 is no more, and it is no more applicable. So therefore, it is important to understand how we can get the benefit of the DTA when the dividend payout is there from the Indian company to the non-resident shareholder. Yes, important, very much important topic, sir. In fact, it can be one day discussion on the interest and dividend part itself here. I will request Raj Chawla, sir, if there can be some session on the interest and dividend from the
Sure,
resident or non-resident point of view, that can be taken here.
sure, sir. Next query, sir, from CA Janme Mahapatra. Sir, who are eligible to contribute to the corpus of the trust, and what will be the maximum contribution?
Look, sir, for this purpose, we have to understand that what is corpus and what is the nature of the trust here. Which are the nature of the trust here? If I say that if it is a public trust, if I say that it is a public trust has a corpus. That is, the corpus means there is a fund base, and there can be some, unless the public trust says that, or unless specify that only a specific purpose is there for the specific person can contribute, anyone can contribute. Take a case here, very much interesting case here. There is a trust which manages a temple, and a person donates into the temple here, and for the purpose of donation, there is a two box. One box says for the building of the trust, and another box simply says Dan Patra. If it is for the purpose of the building of the trust, means it is going to the corpus of the trust, and this corpus has to be used for the purpose of the creation of the building of the trust. Whereas in the case of the other Dan Patra, it is for the regular expenses or regular income of the trust here. So, who is eligible to contest? Anyone is eligible to contest. It depends upon the nature of the trust. Most important thing in nature of the trust, whether it is religious trust, whether it is charitable trust.
Haji sir, namaskar.
If it is charitable trust,
Yes, sir,
if it is charitable trust, anyone can contribute to the trust here. I don't see any restriction on that contribution here.
Sir, next query from CA Sukhvinder Manalji. Sir, please confirm rationale behind under section 115 JB 2 double IH brought forward loss or depreciation, whichever is lower is allowed to be deductible on determined book profit, whereas in case of computation under NCLT, both are allowed.
It is very interesting question, and it is a very lot of debate is there. But I will go into the short here. It says that when you are calculating the book profit, what of the benefit that you can take it, whether you can take the brought forward loss, reason behind the 152 GB, that brought forward loss, or the depreciation, whichever is lower, that is allowed for the purpose of book profit. Yes, you are 100% right. That is book profit, whichever is lower, that will allowed here. Whereas in the case of company under NCLT, both are allowed. The purpose of the NCLT is something different, sir. Purpose of the NCLT is not for the purpose of calculating the book profit. The purpose of the NCLT is to determine the valuation of the company. Here we are not determining the valuation of the companies. We are determining the book value for the purpose of paying the tax. So my request will be there, Manhas Saab, that as far as what I have understood the question is that the purpose of 115 JB is to calculate the tax liability of a company when when the company is not paying the normal taxes. This means that your tax liability is lower than the 18.5% of the book profit here. So therefore, we are calculating for the purpose of MAT, we are calculating the minimum alternative tax, and for this purpose, we are arriving the book value. And for this book value, there is some permutation and combination. Some amount has to be added at, some amount has to be reduced, and some amount has to be added, and then we will reach to the book profit. However, for the purpose of NCLT is for the purpose of valuation method, where the company NCLT for the purpose of valuation method, as per my understanding that, and both the purposes different. So therefore, the method under the NCLT may be different here. He can approach to me directly. If something is there, I can clarify him offline. So.
Sir, next query from CA Janmesh Mahapatra. Sir, is it possible to create a discretionary trust with recoverable transfer?
Very much important, sir. Right now, we are facing the issues in the income tax department that if it is a revocable trust transfer, then there is not a proper transfer for the purpose of creation of the trust. The transfer has to be a irrevocable transfer. And if you go to the Indian Trust Act also, it says that the settler who is transferring his property in favor of the trust for the benefit of the beneficiary, then the transfer should be a irrevocable transfer. It cannot be a revocable transfer. If it will be a revocable transfer, this means the trust can be dissolved at any stage here, which the government will not like that part here. So therefore, we are facing the questions in the income tax department, particularly for the purpose of charitable and religious trust. They are asking us to please show the clause in the trust instrument where there is a irrevocable transfer of the property is there. Now, it says that it is possible to create a discretionary trust for the purpose of creation of a trust. For the purpose of creation of trust, it is there that it should be a irrevocable transfer. And if you go to the section 47 also, 47, I feel that 47.2 or 47.3 says that if there is an irrevocable transfer by the settler to the trustor in favor of the property, then it will not be covered as the transfer under the capital gain also. So if it is a revocable transfer, then it will be also subject to capital gain. So just I am reading the section 47, which says that these are the transactions, these are the transfer, these are not the transfer. 47.3. 47.3. Transaction not to be regarded as transfer. So these are the transactions which is not regarded as transfer. Nothing contained in section 45 shall apply to the following transfer. Any transfer of a capital asset under a gift or a will or a irrevocable trust. Very much important. It should be irrevocable trust. So then it will be not subject to the capital gain. Otherwise, it will be subject to the capital gain here. So the point that I'm trying to say that my understanding says that if it is a revocable transfer, then the trust may not be created, or may be created, but not a problem here. But that trust, the life of the trust will be very temporary here. That the life of the trust will be temporary, and after that, there is a lot of issues will arise. Section 60 will also come into the play because you have transferred the asset, but you have not transferred the income into that part. These are the issues that can also come into.
Sir, next query from CA Sukhvinder Manas. In case a company follows calendar year as accounting year and followed different accounting policy, in such cases, how profit under income tax should be calculated for comparing with book profit based tax liability?
Sir, there is a special section for this purpose. I feel that I have already covered this part. On 100 section, under section 115 JB, there is a special explanation that is already given, and that provide the method how to calculate the book profit, where the accounting period and the previous year are different. If I can go to the 115 JB, just I will read down that part here. Yes, in the second proviso clause, it says that 115 GB2 provided further where the company has adopted or adopted a financial year under the Companies Act, which is different from the previous year under this Act, the accounting policy, the amount standard, accounting standard, the method or rates adopted for this one shall correspond to the accounting policy, accounting standards, and the method and calculating the depreciation and for such period financial year and part of such financial year falling within the relevant previous year. So they have to follow the second proviso in order to get the benefit, in order to calculate the 100 book profit under 115 GB. So Manhas sir, my request is that kindly follow the second proviso of the 115 GB subsection 2, and if you follow the 115 GB 2, you can calculate the you will able to calculate the book profit where the accounting year is different than the previous year under the Income Tax Act.
Sir, there is a query from C. Atul Puriji. Now DDT has been done away with, all the provision still be applicable?
No. When the DDT has already been done, so I just pointed out here, when there is no dividend distribution tax, therefore it is for the purpose of benefit of the shareholder, and they can very well claim the DDT, the benefit of the dividend, and also the rate of the and particularly for the purpose of the non-resident, it is very much important that they will get the they will get the benefit of the lower rate of tax which is given into the double tax avoidance agreement here. So they can very well plan it here, no problem.
Again, query from CA Sukhvinder Manas. Can amount which has to be adjusted on account of business loss or depreciation, whichever is lower, in calculating book profit, be taken partly from both head, or adjustment only against one of these is allowed?
I'm not able to understand. Can amount which was to be adjusted on the account of book on the business loss or depreciation, whichever is lower, in calculating book profit, be taken partly from both heads or adjustment only against one of these or only against? Sir, this question is not clear to me, so I will not able to reply offline online here. Yes, if something is come to offline, I will apply.
From Janme Mahapatra sir, in case of conversion merger, whether carry forward of unutilized MAT credit for fresh 15 years or the period left to be to the previous SSC?
And there's a lot of litigation into this part here. A lot of litigations here. The department take the stance that yes, sir, for the purpose of it says that for the purpose of the calculation of the MAT here, the value which was there before the amalgamation or before the merger, that has to be taken here. But yes, can be utilized. I will say that it is a bit litigated issues that will depend upon my understanding that it has to be properly evaluated here before giving the reply to this part here.
Question: in case a company has overseas operation and pay rupees 5 lakh as tax in that country, if on the same profit in India is tax is rupees 50,000 is payable, will FTC carryover be allowed for rupees 5 lakh or 50,000?
In case of a company has an overseas operation and pay 5 lakh as tax in that country, yes, if on the same profit, on the same in India, a tax is 50,000 rupees, is payable, a tax of 50,000 rupees payable, will FTC carried over, will be allowed with the 50 lakh or 5 lakh or 50,000 rupees? I feel that my understanding is that I'm not gone into the detailed rise of now, but my understanding that it will be 50,000 rupees here.
If the funds are lying in the bank of FDR have been made, will this be treated as application of direct donations?
If the funds are lying in the banks or FDR have been made, will this be the application of donation here? I feel that there is a recent issue on the issued on this issue that was raised on this type of bank balance or the bank uh, deposit here and FDR, and there was a view that was taken by the department that these are not be treated as the application of donation here. These were one of the view, but I am not aware of the total matter which was going on. But I slightly recall that one of the development was like this. Sir, please say a few lines on the relation to the Provident Fund Trust and Gratuity Trust. These are again, a special topic that we have to deliberate. Kindly share the number of Mahapatra Sahab. We can discuss offline also. This is because if you go.
Prakash sir, if you want to share your mobile number, I can type here. So
Yes.
Mr. Mahapatra or Mr. Manas can contact you directly, personally for their queries.
Yes. No
Please,
issue, sir. No issue.
please tell me your number, please.
98182.
Yes, sir.
95840.
95840.
840.
Please check. I have typed in the comment box. So
It is not visible to me, sir. 98182 95840.
already see in the down, it is already there, sir. 98182 95840. So I request our Mr. Manas, and because the queries of these two is there pending, so they will contact you directly because time is already 6:11. So if you want to take query, you are most welcome. Should we take?
No. Yes, sir. I can right now I can reply, but this reply will not be suffice, or I will not able to justify the reply because
Okay.
I have to go in detail here.
Sir. Sir, income of the charitable trust laid unused and the trust is not taking fresh registration under the new amend regime. So what will be the treatment of such income?
Sir, it is advisable right now to apply for the purpose of the new registration. Otherwise, this income will be covered under the 115TD. And if it is covered under the 115TD, the trust has to pay the tax at the rate of maximum marginable rate. So please apply for the purpose of registration if you want to continue the operation here.
In case of dividend rate is specified in 115A and note rate in force. Accordingly, PIL case should be applicable and TT benefit should not be allowed. Is this understanding correct?
Sir, I will read the question. Sir, in case the dividend rate is specified 115A and not rate in force, accordingly, PILCOM case should be applicable. and TT. No, sir. I will like to clarify here. I feel that there is some issue here. Pilcom case was on the issue of the 194E read with the 115 BBA. Means that in the case of the Pilcom, the amount was supposed to be paid to the non-resident for the purpose of participation in India, in the game in India. So therefore their income was covered under the 115 BBA. If the rate of income was covered under the rate of 115 BBA, and the rate was also the TDS was to be applied under the 115 BB under 194E. So therefore, in that 94E, no rate in force was mentioned. The rate was mentioned which is covered under the 115 BBA, and so therefore the DTA benefit was not available into the Pilcom case. Whereas, I would like to again clarify, whereas Supreme Court in the case of the recent engineer excellence case of the software royalty has already distinguished the Pilcom case, saying that the case, the deduct TDS under 195 and TDS under 194E is totally different. Under 195, it says that any sum which is chargeable to tax in India, other than interest or other than the salary, if it is chargeable to tax, the rate of tax will be applied with the rate in force. And if you go to the rate in force, which is section 2 subclause 37A, sub limb 3, subclause 3 talks about the rate in force will be the rate which is mentioned in the specified rate, plus it also says which is specified as per the DTA, which is covered under section 90 or 90A. So therefore, when we go to the section 195, it leads to the rate in force under section 237A, and further it leads to the DTA. So the benefit of the DTA will be allowed at the TDS stage under 195 itself. However, when we follow the 194E, which was for the purpose of 115 BBA, there was not mentioning of the rate in force, and therefore the DTA benefit was not applicable. In that case, the Supreme Court has said that if the non-resident wants to get the benefit of the DTA, saying that no income is taxable to that part, let them file the income tax return, let the claim the refund of that part here. So both are totally different here.
Again, query from him, sir. In my first question, in case of company under liquidation, depreciation and loss, both will be allowed to calculate profit under section 115 JB2. For other companies, loss or depreciation is allowed under section 115 JB23.
No problem, sir. I will reply his all questions here offline here, because there is some issue which is trying to mingle with here, and it will the moment I will start discussion, it will go a bit longer one here.
So with this is the end of our question, and sir, I am very thankful to you for taking this difficult subject very nicely, and you have described all the provisions very nicely. So I am thankful to you. Thank you very much, sir. And I am also thankful to all the members attending this our webinar. So thank you, members. Thank you very much. Thank you, sir.
Thank you, Chawla sir, for giving me that opportunity, and I will be always ready for your service or for the service of the CA fraternity or all the parties.
Thank you, sir.